So I'm going to talk about tax credits for historic buildings rehabilitation. This is going to be real brief, please, and I'm going to say this again in my presentation. Do not take me as the last word on any of this. Changes in the tax code happen on a fairly rapid basis. This is just an overview. Don't start anything until you talk to our tax credit coordinator, an attorney, and an accountant. Don't mess up your taxes. All right, so a little overview of the basics, because we have two programs. We have a federal tax credit program and a state tax credit program, and they share some qualities and they're a little different in other things. One, for each of the programs, the building that you're going to be working on must be a certified historic structure. And they're kind of two of those things. You have to be listed in or a contributing structure in a historic district listed on the National Register of Historic Places, or you can be listed in or a contributing structure in a certified historic district, which is a little bit different and has to do with CLGs. It is kind of arcane and takes talking to the Park Service about. So the best way to deal with that is to file what's called Part 1, which is a request for formal certification from the Park Service. And Tom Marr can help through that step. It has to be a qualifying rehabilitation. There are minimum spending levels for the rehabilitation. The project, any proposed work has to be reviewed by our office, the State Historic Preservation Office, and or the NPS, depending on what kind of tax credit project it is. The work will always have to meet the Secretary of the Interior standards for rehabilitation, which I know you're familiar with. And the work gets reviewed inside and out, whether or not it's a historic district, it's a contributor in a historic district, or individually listed on the National Register. I know that when you're in a historic district and doing historic district review, you start thinking about only the exterior building envelope, but when you're doing a tax credit project, you review the interior work as well, or we review the interior work as well. And depending on the program, the building has to be put to a certain use, certain kind of use, but we'll talk about that in a minute. So it's a tax credit, like the name suggests. It has a tax credit is a deduction from a percentage of your income tax that's owed. What you'll be deducting is a percentage of the expenses that you spend on the project. This is not a refundable tax credit. It's not like the earned income tax credit or the child care tax credit. You don't get it back if you have more of a credit than you had income taxes that you owed. And it's also not transferable. Sometimes tax credits are transferable. You can sell them. The federal tax credit is not transferable. Oh, that's just the federal tax credit. I put that in the wrong section. Federal credit. For the federal credit of qualifying rehabilitation, you must spend more than your basis in the building, not the land. So this is the value of the building itself. You take, you know how your assessment always has the value of the building and the value of the land separately? You take the value of the building, and then it's your basis, which is your basis for tax purposes, which has something to do with the value when you bought it and then depreciation if it's a commercial building. And I don't quite understand how that works, but your accountant will, which is one of the reasons you need to talk to your accountant and not me. The plans must be reviewed by the State Historic Preservation Office and the National Park Service for compliance with the Secretary of the Interior standards before any work begins. And this is what's called a Part 2. You fill out a long form detailing all of the work that you're intending to do. There are plans involved, specifications, and they make a determination of whether or not that's going to be acceptable, and those are the plans that you have to stick to. Now, if you need to make a change in the middle, you can come back and talk it over with the Park Service in our office, and they can make a determination of whether or not the change is acceptable. You're not completely locked in, but everything has to get approved by them or you're risking your credit. Now, some caveats. You have to keep the property for 5 years after you put the building in service to avoid what's called recapture. Recapture means that if you sell the building before the 5 years are up, you have to pay back the credit on a pro rata basis. So if it's, I think the way it works is if you sell it after 4 years, you have to give back 20%. After 3 years, you have to give back, what would that be, 40%, et cetera. And now you have to take the credit over a 5-year period. This didn't used to be true, but 3 years ago when they made changes to the tax code in 2017, they did a lot of tweaks to tax credits and tax deductions, and they actually nearly zeroed out the rehabilitation tax credit, and this was sort of a compromise. So that's another thing that's important in planning projects. It's a 20% credit, 20% of your qualifying rehabilitation expenses. There are some things that are included from the expenses that you can take the credit for. Additions, new additions are not included. They may be allowed as a part of the project, but you can't take the money, you can't count the money that you spend towards the credit. And things like appliances, and in some cases, new cabinetry, there are a number of different things. You just have to read the fine print. There's no upper limit on the credit. As I said, though, it's not transferable. So if you don't have enough tax liability, you may have to project it into future years. It's something you really need to plan with your accountant. In some very large cases, they syndicate these with multiple corporate partners. But usually these are done by corporations in commercial cases, unless it's a very small project for that reason. For more detail, you can visit the National Park Service Tax Incentives page, which has a great deal of information, much more than I can give you now. All right, so we move on to the state tax credit, which is modeled on the federal tax credit. So the building types it covers are both owner-occupied residential buildings and income-producing buildings, as opposed to the federal tax credit, which was just income-producing. The only difference between these two for state tax purposes is the difference in the amount of credit that you can take. For qualifying rehabilitation, you must, for owner-occupied residential properties, you must spend a minimum of $5,000 on the project. We just got this changed last year. A pretty good floor. And for income-producing properties, it's a minimum of a $25,000 investment. So they have the same allowable expenses and the same standards, the Secretary of the Interior standards for work, as the federal credit, but the review is only at the State Historic Preservation Office. This does not have to go to the National Park Service, which makes it a considerably faster process. It can take 30 or 45 days just to get a response back from the Park Service. They're very, very busy. The actual credit under the state program for owner-occupied residential properties with the $5,000 minimum investment is a maximum of a $25,000 credit. So if you spend $100,000 on your project and qualifying expenses, you get $25,000 as a credit. If you spend $200,000, you get $25,000 as a credit. That's the maximum. For income, yes.
Is this the credit? Can you get the credit? Is it post rehabilitation or pre? Do you have to go to you first before you do anything on your building, like the feds do? Okay.
Yes. You have to come to us first. For an income producing project, it's a $25,000 minimum investment, and a $400,000 maximum credit. So that's quite a bit larger. We just increased that a few years ago. But those credits are transferable, which is good because, for instance, a number of owners who, for instance, are doing projects where they start off with a $5,000 investment may not have $25,000 in state tax liability, especially, you know, smaller homeowners on limited income. And for big commercial projects, they may not necessarily have $400,000 in credit, but if they can arrange up front that they're going to have a bank that says, yes, we will buy your tax credit, they can use that to help leverage funding. Usually this is, I believe, transferring at around 89 cents on the dollar when banks buy the tax credits. And they buy the tax credits so that people who have large tax liabilities, like corporations, can use them to lower their tax liabilities. And, you know, if you buy them in bulk, that's 10% off your tax liabilities. That starts to add up. Okay, so just to note, there have been a number of legislative changes over the last 3 or 4 years to our tax credit programs in terms of the floor. The $5,000 floor used to be $25,000. The maximum on commercial properties, that has gone up dramatically. So that may not be reflected. I know it's not reflected in our brochures because our brochures have not been updated, and it is not reflected in some parts of our website. So if you refer people to those things around town, people you know, people who come in front of the commission, please let them know that the best thing to do is to call our tax credit coordinator, not to refer only to the website, because the website may be inaccurate. Also, you may need to caution people, we are maxed out for this year on our tax credits. We're only given, I think it's $3.5 or $4 million a year to give out in tax credits by the Department of Finance and Administration. And particularly because we raised the maximum tax credit to $400,000 on commercial projects, that goes pretty quickly. So essentially we have a waiting list of people who have gotten their projects done and have gotten their certification that their project was done correctly and have an amount of money that they've spent and an amount of money they can get, who have filed and are just waiting for the next fiscal year to roll around so the next pot of money is out there. And that's stacking up. So, you know, it could be next year or the year after before the tax credit actually gets into your hands if you start now. We hate that. We're going to try to get the appropriation raised if we can, but that's all in the hands of the legislature right now. Again, please contact your accountant, your attorney, and this is where I'd start, Tom Marr, who's our Federal Programs and Tax Credits Manager at AHPP, to verify the details. And please do not begin any work until AHPP is contacted and plans are approved. Because if you do work, it's not the right work, you're not going to be able to count it towards your tax credits, and it may disqualify your project if you've done work that doesn't meet the Secretary's standards. Feel free to contact me if you have any questions, but I may just have to refer you to Tom because I don't want to tell you the wrong thing.